Welcome to the Julius podcast. If you focus on the noise, it becomes impossible to make sense of chaos. As many others have observed in trying to make sense of Trump's rhetoric, take Trump seriously, not literally. And so it's time for a deep dive into the financial nuts and bolts of global trade, into why the unraveling post-World War II dollar-denominated trade regime must end in spite of all the noise in the news, and why everyone in the debate, from free trade libertarians to America First economic hawks, all bring valid points to the table, but are also all simultaneously wrong if those points aren't placed within a larger context. Like the famous parable of the blind men and the elephant, everyone is arguing about the nature of the elephant without the context of the full picture, and so all are right, yet also simultaneously so very wrong. For the past 6 weeks, the markets have lurched about in panicky swings, plunging as low as 20% below their all-time highs as Trump rolled out his new reciprocal tariff regime on Liberation Day on April 2nd. The condemnations poured in from all sides. The newspapers, all in unison, chimed in with their new favorite term, proclaiming that Trump had opened the door to market Armageddon. The Democrats howled that Trump was destroying people's retirement funds. Senator Rand Paul mocked Trump's push for reciprocal tariffs, and Trump's claim that trade imbalances are evidence that other countries are ripping off the United States, stating that it's based on a fallacy that in a trade someone must lose, that somehow when you trade with someone there's a loser, that China's ripping you off or that Japan is ripping you off. It's absolutely a fallacy. Every trade that occurs in a marketplace is mutually beneficial. Meanwhile, Thomas Sowell focused on the danger of injecting uncertainty into the markets as Trump keeps changing the rules from one day to the next, stating that it's painful to see a ruinous decision from back in the 1920s being repeated because of the uncertainty that Trump is injecting into the markets, which causes capital investment to stall. Then, only a week after Liberation Day on April 9th, as the bond market showed increasing signs of panic, Trump retreated from his hard tariff stance by suddenly pivoting to provide a 90-day pause. The 75 countries that did not retaliate and instead initiated negotiations to resolve Trump's concerns about unbalanced trade relationships saw their tariffs reduced to 10% during this 90-day pause. The media promptly announced that market Armageddon had been averted. However, belligerent Canada was excluded from that tariff reduction, and China saw its tariffs soar to 125% as punishment for its aggressive trade retaliations. Based on the rhetoric and actions coming out of China, it appears to be preparing for a full-fledged and long trade war. Meanwhile, politicians in Canada were theatrically outraged at being excluded from the tariff pause, with Conservative election candidate Pierre Poilievre proclaiming, "Almost every country in the world got a pause in tariffs, but not us, America's best friend." Of course, he left out the somewhat inconvenient point that Canada has the dubious status of being the only country in the world that joined China in retaliation against Trump's reciprocal tariffs. The announcement of the 90-day pause caused the stock market to surge over 10%, recovering half of the losses of the past 6 weeks in only one day. Then it settled into a narrow trading range as investors waited on clues to see what happens next. The market hates uncertainty. This was clearly just the opening salvo of what promises to be a whole-scale realignment of global trade. Democrats responded to Trump's tariff retreat with howling accusations that this is amateur hour, while many right-wing commentators showered Trump with praise for using this tactic to separate friend from foe and for bringing America's reluctant friends to the negotiating table. Unfortunately, reality is far grimmer, as we shall soon see. Before we dig deeper, for a bit of perspective, it's worthwhile to take a look at the 25-year chart of the S&P 500. It quickly becomes apparent how unremarkable the entire stock market sell-off actually was. In the greater scheme of things, this was a minor market correction that took prices back to where they were in the summer of 2024. On the chart, you can see that prices have respected a rising trend line that has been in place since the market crash in 2008. This sell-off hasn't even come close to taking us back to that trend line, much less break it. So far, the long-term market momentum remains intact despite all the noise. Indeed, what stands out from that long-term chart is that in 2020, during COVID, prices soared even as global economic activity was drastically curtailed by lockdowns. Clearly, central banks flooded the markets with vast quantities of printed money to prevent a market meltdown, which led to the rather obvious overheated market surge from 2020 to 2022 as all that printed money found its way into the stock market. Then, as stock prices stretched ever further away from real fundamentals, the overheated market jumped on the excuse of the start of the Ukraine war to sell off again in early 2022. Stocks corrected back to that trend line, which held firm once again. But the steep surge that followed the market correction in 2022 and 2023 strongly suggests that Biden's government and the Fed stepped in once again to flood the market with loose monetary policies after the outbreak of the Ukraine war, which once again reinflated a massive hyperactive market bubble that peaked in early 2025. And once again, Trump's new tariff uncertainty provided investors with the perfect excuse to sell off an overheated and overbought market that had become completely detached from the underlying fundamentals. As seasoned traders will tell you, trade the chart, not the news cycle. But now let's turn our attention to more serious matters, like the tariffs themselves and the trade imbalances that Trump keeps speaking about. A quick search on Grok reveals a strange paradox that is exposed when comparing the annualized total returns in US dollars for the US S&P 500 over the past 10 years versus stock market returns in Canada, China, and the EU over that same 10-year period. The United States has come out far ahead of all the others with a 13.8% annualized return, compared to China at 4 to 5%, Canada at 6 to 8%, and the EU at 4 to 5%. So the country with the best stock market returns is complaining that it is the one that's been most badly hurt by trade imbalances, while those who protect their industries with one-sided tariffs and other unfair soft forms of protectionism lag far behind. Something doesn't add up. If tariffs are the solution to America's economic problems, why has the country with the least tariffs outperformed all the countries that have used tariffs and other soft trade barriers to protect their economies from their global competitors? Before we let these paradoxical data points lead us astray, we have to dig a little deeper into the story. After all, stock prices are merely one small part of a much larger global financial jigsaw puzzle. From the very start of his second term, Trump has stated his intention to reform the trade regime of the post-World War II era. As Trump would say, they're treating us very unfairly on trade. The last time that the US had a positive trade balance with the rest of the world was in 1975. Since then, the US has consistently and increasingly bought far more stuff from the rest of the world than the rest of the world buys from the United States. As we'll soon see, despite the blooming US stock market, these chronic trade imbalances are indeed a recipe for financial disaster. By 2024, the US had a combined annual trade deficit with its top 30 trade partners to the tune of a colossal $1.2 trillion per year. And that's before we factor in the cost borne by the United States for essentially bankrolling the national security of all its NATO and Asian allies. Contrary to Trump's oversimplification of the issue, which focuses on reciprocal tariffs in an effort to fix trade imbalances on a country-by-country basis, what matters is the global trade balance. Country-by-country trade imbalances are an unrealistic measure. For example, if a country like Canada taxes its own citizens to death and hamstrings its own industries with red tape, there's no way that we can afford to buy as much stuff from the United States as they buy from us. On paper, the net benefit of the trade imbalance is in Canada's favor. But a quick look around Canada's rapidly declining standard of living undermines any illusion that this leads to winning. Canada's GDP per capita ranks between West Virginia, which is America's second poorest state, and Mississippi, America's poorest state. That's not winning. Meanwhile, despite the US being on the losing end of that trade imbalance, they benefit tremendously from being able to buy the few things we do produce, like oil, for as cheap or cheaper than they can produce them, regardless of whether we're buying other stuff from them in equal measure. In his interview with Tucker Carlson, Bob Lighthizer, Trump's U.S. trade representative during Trump's first term, confirmed this. The balance of trade between two individual countries is largely meaningless. The only thing that actually matters to a country is whether there is a persistent net positive or net negative trade balance on global trade. But why? How can something that isn't a problem on a country-by-country basis nevertheless be an existential problem when those countries are added together? This is where the story begins to get interesting. In his 2003 letter to Berkshire Hathaway shareholders, Warren Buffett laid out a stark warning about the detrimental consequences of allowing these chronic trade imbalances to persist through his analogy of two fictional countries, Thriftville and Squanderville. And so I'd like to read you the relevant paragraphs from Warren Buffett's story. Our trade deficit has greatly worsened, to the point that our country's net worth, so to speak, is now being transferred abroad at an alarming rate. A perpetuation of this transfer will lead to major trouble. To understand why, take a wildly fanciful trip with me to two isolated side-by-side islands of equal size, Squanderville and Thriftville. Land is the only capital asset on these islands, and their communities are primitive, needing only food and producing only food. Working 8 hours a day, in fact, each inhabitant can produce enough food to sustain himself or herself, and for a long time that's how things go along. On each island, everyone works the prescribed 8 hours a day, which means that each society is self-sufficient. Eventually, though, the industrious citizens of Thriftville decide to do some serious saving and investing, and they start to work 16 hours a day. In this mode, they continue to live off the food they produce in 8 hours of work, but begin exporting an equal amount to their one and only trading outlet, Squanderville. The citizens of Squanderville are ecstatic about this turn of events, since they can now live their lives free from toil and eat as well as ever before. Oh yes, there's a quid pro quo, but to the squanderers, it seems harmless. All that the thrifts want in exchange for their food is squander bonds, which are denominated naturally in squander bucks. Over time, Thriftville accumulates an enormous amount of these bonds, which at their core represent claim checks on the future output of Squanderville. A few pundits in Squanderville smell trouble coming. They foresee that for the squanderers both to eat and to pay off, or simply service, the debt that they're piling up, will eventually require them to work more than 8 hours a day. But the residents of Squanderville are in no mood to listen to such doomsaying. Meanwhile, the citizens of Thriftville begin to get nervous. Just how good, they ask, are the IOUs of a shiftless island? So the thrifts change strategy. Though they continue to hold some bonds, they sell most of them to Squanderville residents for squanderbucks and use the proceeds to buy Squanderville land. And eventually the thrifts own all of Squanderville. At that point, the squanderers are forced to deal with an ugly equation. They must now not only return to working 8 hours a day in order to eat, they have nothing left to trade, but they also must work additional hours to service their debt and pay Thriftville rent on the land they so imprudently sold. In effect, Squanderville has been colonized by purchase rather than by conquest. It can be argued, of course, that the present value of the future production that Squanderville must forever ship to Thriftville only equates to the production Thriftville initially gave up, and that therefore both have received a fair deal. But since one generation of squanderers gets the free ride and future generations pay in perpetuity for it, there are, in economic talk, some pretty dramatic intergenerational inequities. Let's think of this in terms of a family. Imagine that I, Warren Buffett, can get the suppliers of all that I consume in my lifetime to take Buffett family IOUs that are payable in goods and services and with interest added by my descendants. This scenario may be viewed as effecting an even trade between the Buffett family unit and its creditors, but the generations of Buffetts following me are not likely to applaud the deal, and heaven forbid, may even attempt to welch on it. Think again about those islands. Sooner or later, the Squanderville government, facing ever greater payments to service debt, would decide to embrace highly inflationary policies. That is, issue more squanderbucks to dilute the value of each. After all, the government would reason, those irritating squander bonds are simply claims on specific numbers of squanderbucks, not on bucks of specific value. In short, making squanderbucks less valuable would ease the island's financial pain. That prospect is why I, were I a resident of Thriftville, would opt for direct ownership of Squanderville land rather than bonds of the island's government. Most governments find it much harder morally to seize foreign-owned property than they do to dilute the purchasing power of claim checks that foreigners hold. Theft by stealth is preferred to theft by force. Warren Buffett's analogy provides a grim warning of what is happening to America. Instead of accumulating capital through savings that can be reinvested back into the economy, America is funding itself by issuing mountains of IOUs, squanderbucks, by selling bonds and printing money, dubiously nicknamed quantitative easing. In the immediate aftermath of World War II, total public and private U.S. debt as a percentage of GDP stood around 120%. Today it exceeds 360%. But because there's a limit to how much debt any business can carry without being crushed by its debts, most of that debt is accumulating in the hands of the government as a direct liability to taxpayers. As of today, the U.S. national debt is closing in on $37 trillion, more than $323,000 per U.S. taxpayer. This raises several questions. To what degree is mass migration being used as a deliberate strategy to try to outrun spiraling debts in Western countries in an effort to grow their economies by growing the population? Mass migration is, above all, a desperate last-ditch economic strategy for nations that have trapped themselves in an unsustainable debt spiral. Canada has already reached the point where GDP per capita is shrinking, yet the economy is growing nonetheless, just barely, simply because Canada is using mass migration as a way to grow the economy. Secondly, is all that inflation that you see at the grocery store a deliberate strategy to try to inflate away the accumulating debts? Virtually every country in history that drowned itself in debt and got addicted to government spending has turned to this dirty trick to try to keep the party going rather than tighten its belt and face its problems. From Roman emperors shaving the coins, thus debasing their currencies, to the most spectacular disasters in money printing from the 1920s in Weimar Germany to the early 2000s in Zimbabwe. Of course, the government can only raise taxes so far before strangling the economy, so all that debt is piling up in government hands. We've reached the point where bonds are being issued to raise the money to pay the interest due on older bonds. Federal debt as a percentage of federal revenue, i.e. tax revenue, has exploded from around 200% in the late 60s to around 700% by 2025. If interest rates ever truly surge to reflect this increasingly risky situation, i.e. if Thriftville ever starts to worry about Squanderville's ability to service its debts, the entire house of cards will instantly come crashing down as interest payments balloon to swallow the entire US economy. As Elon Musk has indicated on X, the biggest threat to the citizens of the United States is uncontrolled government spending, creating ruinous debt. Furthermore, as long as the trade imbalances persist, what do foreigners do with all their excess squanderbucks? If they're not going to buy American goods and services to return those squanderbucks back to American soil, they are instead going to use those squanderbucks to invest in the US stock market, buy US bonds, or buy US assets like farmland, real estate, ports, corporations, etc. And the profits from these things causes still more squanderbucks to accumulate in foreign hands. As long as these trade imbalances continue, this has, quite literally, become a self-reinforcing system that is slowly spiraling towards an inevitable catastrophic conclusion. A quick search on Grok suggests that, as of 2024, foreigners owned an estimated 33% of US treasuries, 27% of US corporate bonds, and 18% of US stocks. And when considering the total value of all assets in the United States, including stocks, bonds, real estate, farmland, ports, etc., though it's hard to pin down exactly, foreign ownership of these total assets is likely in the range of 10 to 15%. To echo Warren Buffett, this is what colonization by purchase rather than by conquest looks like. And since every country is playing the same game, they are all locked in a perpetual currency war, collectively waged against their own people in order to prevent their own currencies from becoming stronger than the ever-weakening US dollar, which would choke off their lucrative trade relationships with the United States. The post-World War II era may not be a chaotic hyperinflationary event like what happened in Weimar Germany or in Zimbabwe, yet, make no mistake, this is a managed global race to the bottom. Since President Nixon took America off the gold standard in 1971, the US dollar has lost over 98% of its purchasing power in terms of gold. Squanderville is using the printing press to try to outrun its debts. Indeed, two of the biggest reasons why America went off the gold standard were to give itself the flexibility to print money to pay for its wants. Money printing is, after all, a hidden tax for which you don't have to ask permission from the people. And to deal with the balance of payments issue on global trade. Balance of payments sounds harmless, something dry accountants would talk about, but it is anything but. This is existential. As long as every dollar was backed by an equivalent amount of gold, financial discipline was imposed on the government, which had to find more gold before it could print more money. This is why libertarians all want to go back to a gold-backed currency. But even the gold-backed system had a fatal flaw, global trade, because as soon as there's a trade imbalance, the gold-backed system begins to fall apart. Before the gold standard was broken by Nixon, every trade imbalance that left more US dollars in the hands of its foreign trade partners meant that if those foreign holders didn't want to buy more American stuff, they could instead call in their IOUs by redeeming the equivalent dollar value in gold. In other words, instead of buying American steel, oil, or cheeseburgers with their extra dollars, at the risk of creating competition for their own domestic steel, oil, or cheeseburger sellers, they could instead demand that the US government open its vaults and hand over an equivalent amount of gold. As world trade increased in the 19th century, this dollar for gold exchange became a major banking issue on the world stage. By the 1870s, a world gold standard emerged between trading nations, which allowed nations trading with each other to settle international trade and currency imbalances by shipping gold back and forth, which they regularly did. Indeed, the US shipped significant amounts of gold to Europe during the 1950s and 1970s on transatlantic steamships. However, while this system imposed financial discipline on national economies, it could also be quite disruptive. Severe gold outflows sometimes triggered deflation or banking crises, as seen in the United States during the 1890s, as outflows sucked so much gold out of the American financial system that the American economy was starved of money for issuing loans, settling payments between companies at the national scale, and so on. How do you pay for things on the home front if there's not enough gold-backed dollars left in circulation because it's all been shipped overseas to settle trade imbalances? The First and Second World Wars completely destroyed this gold-backed system as financial discipline evaporated. Gold outflows became so severe during World War I that the United States restricted gold exports to foreign countries. In 1933, during the Great Depression, the United States went even further by suspending convertibility between gold and the dollar. Then in 1934, FDR banned all private gold ownership in the United States and revalued gold from $20 an ounce to $35 an ounce, thereby significantly devaluing the dollar in order to try to stabilize the shrinking economy. This emergency monetary regime remained in place until the Bretton Woods Agreement in 1944 at the tail end of World War II, which formalized this new regime by officially making the dollar the world's reserve currency, convertible to gold at $35 an ounce for foreign institutions, but no longer for foreign individuals. They were henceforth barred from converting their dollars to gold. This new financial order was overseen by two new purpose-built international institutions, the International Monetary Fund and the World Bank, both also created in 1944. At that time, the United States still held around 20,000 metric tons of gold in reserve. Remember that number. As early as the 1950s, the first cracks already began to appear in this new Bretton Woods monetary system because of persistent trade deficits, which were causing a significant drain on U.S. gold reserves, despite the fact that the United States had deliberately encouraged those trade deficits as an act of goodwill in the aftermath of World War II. These trade imbalances were designed to help the economic recovery in Europe and Japan. After all, these war-torn countries needed to buy a lot of stuff to rebuild their nations, but had very little to sell to the United States since their entire manufacturing base lay in ruins. The United States also deliberately turned a blind eye to their protectionism because, by allowing a one-way trade flow, this would allow these impoverished war-torn nations to quickly build up financial reserves that they could then use to invest in rebuilding their economies. There's an important lesson here before we go on. Trade imbalances allow a nation to quickly build up large capital reserves without having to fund their growth with debt. The nation building up its capital reserves through trade surpluses is essentially funding itself with excess dollars left over from trade imbalances, which it can then use to reinvest back into its own economy rather than having to go to the bond markets to raise capital via debt. By the 1960s, maintaining this monetary trade system required persistent central bank interventions and restrictions on gold redemptions, as U.S. gold reserves dropped ever lower. By 1960, U.S. gold reserves had dropped to around 15,000 metric tons, despite the fact that the U.S. government was continually attempting to replenish its own gold reserves by purchasing substantial amounts of gold from its own domestic gold miners throughout this period. In desperation, the United States began encouraging foreign countries to hold U.S. dollar reserves instead of gold. By 1968, the official dollar-gold peg at $35 an ounce was so distorted because there was so many more paper dollars than gold that U.S. gold reserves, which had by then fallen to below 10,000 tons, only covered a fraction of outstanding dollars abroad, causing confidence in the dollar to fall. An unofficial black market trade emerged, like it always does in countries with an artificial exchange rate that doesn't reflect reality, which exchanged gold at a much higher valuation. Holders of dollars had become so concerned about dwindling U.S. gold reserves that they were willing to take a major haircut on the value of their dollars in order to exchange them for gold. Speculators piled in, increasingly betting against the dollar. In countries like France and Switzerland, which were getting increasingly nervous about America's ability to meet its dollar-for-gold obligations, began demanding large quantities of gold to be shipped across the Atlantic to cover their dollar reserves. By 1970, this drain on U.S. gold reserves caused inflation in the United States to hit 5.7% as unemployment surged and economic stagnation set in. And so, in 1971, President Nixon ended the Bretton Woods era by taking the US off the gold standard altogether. Dollars could no longer be redeemed for gold, which allowed the US to print its way out of its financial problems. From that moment onwards, the fiat US dollar was backed by nothing more than the public's trust in the government's promise that the nation would remain solvent and wouldn't inflate away the value of its currency via money printing. This allowed the government to inject a massive amount of liquidity into the United States economy via money printing, on demand, without having to back new dollars with an equivalent amount of gold. By the time Nixon closed the gold window, U.S. gold reserves had fallen to a mere 8,100 metric tons. Of course, with the dollar unpegged, the U.S. was now free to print money to its heart's content. By 1980, U.S. inflation peaked at 14%, while interest rates peaked at 20% in order to try to rein in this rampant inflation. However, with money printing now established as the government's go-to tool to solve economic problems, and with a dollar untethered from gold, inflation became a deliberate stealth policy tool to inflate away debt. Governments even created an official inflation target. Investors, stock markets, real estate owners, and those with pension funds loved it because on paper, everything appears to be permanently going up in value thanks to inflation, even as government can then pay for its extravagant spending promises by levying capital gains taxes on all those fake rising values caused by inflation, even as yesterday's debts become easier to pay back with tomorrow's inflated dollars. But the trade imbalances remained nonetheless, only now, instead of gold accumulating in foreign hands as a consequence of trade imbalances, dollars and bonds are accumulating in foreign hands. By consequence, this is leading to a steady accumulation of land, real estate, stock shares, and other assets in foreign hands. Even Nixon, despite breaking the gold standard, was fully aware of this ongoing problem. He imposed a 10% tariff on imports, similar to what Trump is trying to do today, to try to deal with these persistent trade imbalances. The world knows that the current dollar-backed monetary order isn't working any better than Bretton Woods did. But what must be done to fix it? Some want to return to the gold standard, and indeed many central banks are currently stockpiling vast quantities of gold, but more on that shortly. The BRICS countries are flirting with creating a commodity-backed currency. Bitcoin has ambitious goals of creating a currency outside of the control of central banks. And central banks in Western nations are all working on some kind of digital currencies that are intended to give central planners much more leverage, carrots and sticks, over your buying and selling choices, which they hope to somehow solve their problems by being able to squeeze you hard enough to make up for irresponsible government spending and money printing. We may not know yet what the shape is of things to come, but everyone is taking steps to prepare for de-dollarization. But while some of these options might, in a theoretical utopian scenario, be able to rein in out-of-control money printing and out-of-control government spending, or scratch the itch that central planners feel to give themselves more control, none of these solutions addresses the underlying issue of trade imbalances, which can destroy entire nations even if the politicians and bankers play by all the rules. And of course, everyone who benefits from the current inflationary monetary regime and the current unbalanced global trade system, investors, domestic corporations, retirement funds, homeowners, bloated government payrolls, politicians who buy votes with out-of-control spending, and all the foreign nations, foreign companies, and international megacorporations that are on the winning side of these unbalanced trade relationships, they are all strongly motivated to preserve the status quo, even if that status quo leaves America spiraling towards an existential reckoning at some point in the future when Squanderville's bills become due. Trump didn't create this mess, and he's the first president in my lifetime who's taking a very aggressive pivot to confront it. His tools of choice to try and fix this are tariffs and trade barriers. But what he's up against isn't just a technical nightmare to solve. The very act of trying to solve it also risks sparking a revolution at home and a trade war abroad, among all those who benefit from Squanderville's debt-funded lifestyle and think it can continue forever without consequences. The problem with centrally planned systems is that the incentives lock the system in place, creating a self-perpetuating cycle. By the time everyone recognizes that the system is broken and is putting everyone at risk, the system itself has become so fragile and brittle, and everyone so dependent upon it, that it becomes nearly impossible to fix without risking destabilizing the entire system and plunging the entire nation into an existential crisis. And in the global post-World War II era, in which everyone's markets and financial systems are interconnected, any national crisis quickly spirals into a global one. As Wall Street likes to say, when America sneezes, the world catches a cold. Yet the longer that impending crisis is deferred and left unaddressed, the bigger the reckoning will be when it finally happens. Elon Musk has described America's looming bankruptcy as a ticking time bomb. By pivoting to address this, Trump is hoping to engineer a soft landing. The choice taken by generations of previous presidents of punting this problem down the road for the next president to deal with is no longer an option. Even before Trump returned to office, changes in the bond markets were flashing alarm bells, signaling that the status quo of the post-World War II era was about to come to a catastrophic end, as bond investors begin to lose faith in America's ability to service its mounting debts. As the old saying goes, at first you go bankrupt slowly, and then all at once. A brief recap sets the stage for understanding the dangerous situation that is developing in the bond markets. This concludes the free preview of this podcast. To hear the remainder of this episode, in which I dive into the emerging bond crisis, soaring gold sales, and China's hostile mercantilism, I invite you to sign up for a paid subscription on my Substack. My essays and podcasts are 100% supported by people like you. Thanks for listening to the Julius Ruschel podcast.